Welcome to the Financial Architects Podcast. I am your host, Evan McCoskey, and I'm joined by partner from Financial Architects and Chief Investment Officer, Larry Steinberg. Larry, great to have you as usual. You said right before the election that Powell would show he was more politician than economist and cut rates. He did it, but 50 basis points? Wow, what's your take?
Well, first, I think it's an admission, and I can't believe the markets didn't understand this, but it's an admission that the economy is much worse than they thought. Because if you're coming in for a soft landing, you don't need 50 basis points. You need a gradual, if you believe the kind of Keynesian economist approach to all this. I also think that it demonstrates that they know that inflation is about to come back up, and they aren't going to be able to declare victory. And now it kind of gives them cover for inflation dipping back up. And by the way, my prediction is that at some point, next year, that the 2% number that they say is normal for inflation, that's going to morph, and they're going to say 3% is their target inflation rate. And I think that the truth is that the 2% was always arbitrary. It was literally a number that was thrown out at a speech with no data behind it, and it got adopted. But the reality is that I think that they want to have a higher inflation rate going forward, because that's how you inflate your way out of the debt. You pay it back with cheaper dollars. That's just kind of reality. And so there's an admission, I think, that the economy is worse than they're saying, and I think it's an admission that inflation is going up, or they're kind of trying to get ahead of it. Because if they kept it up and inflation came up anyway, it blows their entire mantra of what they were doing, and then it just makes them look bad. I think they know they can't stop it from going up, and this way they can say, "Well, you expect a little inflation to come after a rate cut, right?" But the bottom line is people should batten the hatches for what we got coming next.
But Larry, all these prominent people, you see them on television, they're saying the Fed just engineered a soft landing.
Well, the people that are saying that are the people that have a vested interest in there being a safe landing, right? Those are the people that are, that need the stock market to be up, that don't want to, that maybe are seeing the negativity and they want to unwind their positions right now and get out before everybody else. It always seems that when things crash, some of the smartest guys already got their money out. And oftentimes you would see them, they've been on TV talking up the economy and the stock market at the same time they're selling, right? And people don't point it out for that. But, I think we've actually been in a substantive recession for a while here, right? And the only reason that we're there is because they've kind of redefined what a recession is. And also that we've spent, $2 trillion in stimulus, right? And you have a deficit of less than 2 trillion of like 1.6, 1.8, and an economic growth of like 1.2. Those numbers are rough there, but like that means that we're not even getting a multiplier effect for the deficit we're spending. So numbers are propped up. Things are not looking good, and I'm just going to be honest with you. Like, we're just starting to see the effect of the huge deficit spending, right? We are at spending levels that are normally, deficit levels, I should say, that normally accompany wars and recession. And I think you have substantive articles, like I said, that we're already in a recession. I think for all intents and purposes, we're already in a world war, right? We've got wars. Maybe it's not our troops directly fighting, but we got wars on multiple continents right now.
Proxy war. We're in a proxy war.
Yeah, but I mean the effect of a proxy war versus a real war. We're talking in economic terms here, right? Yes. Not trying to be callous about it, but there's we're definitely have enemies, and we're definitely we're giving weapons that are being used to kill people, right? We're giving money that is being used to kill people. Whether it's our people doing it or not, that's a war.
So, as you said, we're in a war and a recession. It seems, though, a little bit overly dramatic to go that far, no?
Well, I mean, the thing is that you often see is that things happen slowly until they don't. things are creeping, and then all of a sudden something flips, right? We saw that in 2000, in the Great Recession when, people were kind of ignoring things and markets were up until we hit this turning point. Paulson goes down to Congress and says, like, literally the world is falling apart. I don't really believe that, but then all of a sudden, overnight we had a massive recession. I remember back when I was in high school, I'm dating myself, but in the 1987 crash, right? And literally the day after the crash, I had, there was one kid, this girl that I knew at coming to school that was, literally just in tears. And apparently she overheard her parents saying that they just lost her college fund in the stock market, right? Now, having your money for you're going to need, and in a year later or 2 years later for your kid's college fund isn't a great idea anyway. But we all know people sometimes make overly aggressive, decisions. But she was just aghast. So no one ever there's always people out there that are always saying things are doom and gloom. There's always people out there that are always saying it rosy. There's very few that kind of like pick the spot and say like, hey, this is bad. I think we're at one of these points, and you just got to look, past the surface. I really think that the employment numbers that people are kind of ignoring a lot, or at least a lot of people are ignoring a lot, right? We had a single modification that knocked 800,000 jobs being created out, right? And then we've never had a period, and you keep hearing me talk about it, where they keep on, changing the numbers down. But when you dig a little deeper, there's a couple things that really bother me in the employment numbers. One is that if you take out government jobs and you take out jobs going to immigrants, both legal and illegal, there's no net job gain in the last 3 years. And when you couple that with the fact that lots of people have lost, full-time employment with benefits and have replaced it with gig economy jobs, or they're consulting rather than having a paid position, right? That's not good. And so it really hasn't hit like the bottom employment number, like the headline employment number yet. But more and more people are kind of realizing this, like, these numbers aren't good. And, if people aren't working, that's ugly. And basically,
I'm sorry, go ahead.
So, you got to understand that, like, in the bigger picture here, that, this whole situation is a big fiscal drag on government spending, right? Because the full-time jobs, when they get replaced with the gig economy, right, then a lot of those people, gig economy, they're probably potentially qualifying for benefits. They're qualifying for Medicaid because they don't have health insurance anymore, and they're you can have a decent income in the U.S. and get Medicaid, and so that person's become someone paying into the system to someone's taken out from the system. And, due to inflation, people's budgets are getting uglier. I mean, the inflation rate has come down, but you still got to look at it. It was at 9 and now it's at 2.5, depending on what numbers you look at, right? But it wasn't like that 9 went negative, right? People got the 9 and the 2, right? And so, and a lot of things are just way, way more expensive than they are right now. And if someone had, a normal everyday American had $1,000 kind of like, free money in their budget, their car insurance went up, gasoline went up, their utility bill went up, their, everything went up, and that $1,000 may not be there anymore, right? So they're not spending that money into the economy. They're not going out to eat as much. There's just a lot of drag there. And all of that is bad for the budget.
So what should we do? Should we, run and hide and head for the hills?
No, I think there's a couple core things people need to do, right? And this is always true, but it's even more true when things are slowing. Get those credit cards paid off, right? Get out of debt. That, because those things are at 20, 25%, right? It's impossible to get out of that kind of debt. And they need to have some money set aside. I mean, the numbers, depending on where you get it, about the percentage of the people that don't even have $1,000 in savings and couldn't handle, a period of unemployment, like they need to have, and the numbers vary between different people and what you got going on. But you really need to, you really need to batten up it for the short term. And then for a lot of people, their investment time horizons need to shorten, right? It may be they have surplus capital and they want to put it to work, but don't put it to work in something where it's going to be tied up necessarily, unless you've got plenty of reserves. If you don't have reserves, you shouldn't be, buying, I don't care what you think about the stock market. You don't buy stocks, because generally when things go bad for you personally, it's when the economy goes bad, and it's when the stock market goes bad, right? So if you're putting money in the stock market and you don't have a rainy day reserve fund, like, just understand that, like, that money may be worth a third less, when you actually need it.
Gotcha. But doesn't value investors like Warren Buffett say invest when things are bad?
Oh, absolutely. When blood's in the street is oftentimes the absolute best time to be investing, but investing long term, right? Buffett is always talking about how, he's not looking at day to day or year to year, and he's buying things that he thinks are going to do well over decades, right? So understand that type of value investing, which is, I really believe in, and, we try to take advantage of things where dislocated. But the reality is that is when you're buying for the long term, right? If you're buying when there's blood in the streets and it gets bloodier, and, the little money you have is now, worth less, that's not a good scenario, right? But also look at this. Buffett has never held as much cash as he does now. And he has been selling a lot. He's got huge positions in the number of stocks he has, and a number of them he's, cut dramatically. And you would argue that he holds so much of them that he's cutting and selling as fast as he can without pulling the greater market down, right? Because people pay attention to what he's doing. And, it doesn't really matter whether he's doing that because thinks he'll be able to buy the same stocks cheaper in a year, or whether he just, thinks that things are really bad and, he doesn't want to lose as much money, because he can never really be fully uninvested. He just is managing too much money. We just got to be thinking about this. That, like, this is an ugly situation. It's not being addressed properly, and people need to be prepared.
Interesting. So what are you telling clients, Larry?
Well, it really varies between the client, right? Some of my clients, they need to batten up the hatches. They need to grow their reserves. They need to make sure they're not going into debt. They need to watch their spending. But this is also already creating opportunities. And so for other clients that are maybe more liquid or have more money, not money in a relative sense. In other words, they have the short-term kind of covered. Like, now's the time to go find some things and be prepared to go jump on things when the values are created. So opportunities are absolutely being created by all of this. But you can't, if you don't have the short-term covered, you can't really invest long-term. So it's going to vary between different clients. But
isn't the interest rate cut going to spur growth in the economy and rise all tides?
No. It really isn't. And first of all, people talk about that the stock market's always higher after a rate cut, right? But there's also, you see people out there arguing it's always lower after a rate cut, right? Because they're cherry picking the time frame and they're cherry picking the data, right? It's like, oh, it's usually down 6 months, but it's usually up a year later, right? So some people are saying using the six figure as a negative, and some people are using the 1 year as a positive, right? And also this is a much bigger rate cut. There have been very few 50 basis point rate cuts that they've done. And usually a year later, after a 50-point cut, things are lower. But once again, it's cherry picking data. It may be that you look into that and say, all right, I'm going to wait 6 months and then buy, because that's what we've done. That's what has worked in the past. Just the idea that a rate cut is going to create economic growth or solve problems. No, it's an admission that there's problems in the economy, and they need to be dealt with.
Can't we just look at the past and get our roadmap forward?
Well, yeah, but we're completely uncharted waters, right? As I mentioned before, we've never had these kind of deficit spending without a declared war or a declared recession, right? So, if it gets bad enough, if those two things become where they have to declare them as that, like, how much worse are we going to be? And we've never, this is a scenario that's never happened again. We've never had the interest payments on our debt skyrocketing like we are now. When the interest rates were really low, a very small number on a very big number is manageable. But now we got a big and growing number, and it's a bigger number. I mean, the deficit situation is going to get really ugly because pretty soon our required interest payments are going to be bigger than defense spending. It's going to be bigger than Medicare, right? So, and before it was like a rounding error in the budget. Now it's going to be a big chunk of the budget, right? And we have, we're having deficits before. Now we're going to have structural deficits where there's no way to avoid it. And then the other thing I have to say is that people think is that, just because the stock market goes up, like the stock market going up doesn't put food on people's table, right? I've seen, arguments right now saying that stock ownership in the U.S., like direct stock ownership, not including people's pension plans where somebody else is managing it, is at a lower percentage than it ever is before, so just because the stock market goes up doesn't mean that that's going to help people.
So I give up. I give up, Larry. Do I run for the hills or not? Yes or no? Should I stay or should I go?
Well, if you move to the hills, inflation's still there, right? There's no inflation. But seriously, no, I mean, there are ways to save and invest and get around this. Kind of the key is your ability to save and invest in order to deal with what you've got coming, right? And you're going to need to be proactive. Most people are reactive, right? Most people don't start cutting their spending until the credit card bills can't be paid every month, and then they see the interest payments, right? Like, you need to be not getting in that situation now. I mean, I think I've mentioned this before, but there was a stat saying that a third of the people in the country didn't know how they were going to pay for their vacations that they were taking this summer. Like, they had spent the money and they didn't know if they're going to, and there was another chunk that just knew it was going to be on credit cards and they were going to have to pay it off over a while, right? Well, I don't know that that's the best way to go about being fiscally solvent.
Gotcha. Speaking of level-headed, what do you think that is being overlooked between the doom and gloomers and the people wearing rose-colored glasses?
Well, I think that the one thing that isn't being talked about, and granted, this is an old term from a long ago, but it's what they call the bond vigilantes.
Who?
So the one thing that people have to fundamentally understand is that just because the Fed cuts rates doesn't mean that the cost of money goes down, right? The biggest driving factor is what the treasury rates are, right? What a 6-month T-bill or a 10-year treasury is, because those are kind of the risk-free rates. And, as far as the economy looks, and we can argue whether they really are risk-free or not, but, and so investment returns are looked at as having to have a margin above that, right? And if returns need to have a margin above that, so does the interest that banks are charging or people are paying on their mortgage that is being charged on business loans. All of that's related to the treasury rate, not the Fed rate. So theoretically, the Fed lowers rates and they're able to sell treasuries at a lower rate, but investors have to buy them, right? So if the people buying the treasuries aren't willing to buy it at 4 and they're only going to buy it at 4.5, then that's what's going to happen. These treasuries are not sold specifically like picking you and make that deal. They're sold at an auction and people bid on them and investors bid on them. And if you're, when you place a bid, if you're only, let's just say a bond has a par value. Well, they do have that par value of 1,000 and, it's a 4.5% interest rate attached to it, but you're only willing to take a 5. Well, then you bid $950 for the $1,000 payout down the line, right? And if there's not enough buyers, you'll get filled at that price. So just because the Fed cuts rates doesn't mean the actual rates come down. And there has been periods in the past where that's been a problem. And I think that that's even potentially a larger problem right now than people are expecting, because they've been playing games. Janet Yellen's been playing games with the Treasury issuance. She's only been issuing short-term treasuries, to finance the current debt and to also refinance longer-term bonds that are coming due. But that just means they got to be refinanced, 6 months down the road. And next year, you're looking at a large, number, trillions and trillions and trillions in debt that has to be rolled over. And if they roll it over at shorter term rates that are still higher, or they put it into longer term, and it's still going to be oftentimes at a higher rate than the 2, the 5, or the 10-year bonds that are rolling off were at. Those were often at under 1, and now if it's at 4, like your amount of interest on that portion of the debt's just gone up 4 times. So the budget numbers look really bad, and that's actually one reason why a bunch of congressmen, or specifically senators, wrote a letter and wanted a 75 basis point pay cut, right? Because they want to spend money, and it's even tougher to spend money, even though they're spending deficits now. It's tough to argue that you need to spend even more money when you've got a bigger and bigger deficit, because most people get the fact that these deficits aren't good, and people are going to look at it and just realize like something's off here, right? And when people get negative, the negative emotions come through. So when they start hearing news about every day about budget deficits and, debt, it's going to happen. And, one of the things people also have to realize is that in the past, it used to be central banks from foreign countries, foreign investors used to buy up a big chunk of our bonds, right? Of our treasury bonds. They don't want to do that anymore. First of all, most central banks are much more interested in buying gold, especially the Chinese, than they are in buying, U.S. treasuries. And they're trying to get independent from the U.S., right? If the United States owes you a lot of money and you're about to get in a war with them, or you're fighting them in a fiscal war, right? The U.S. always has the ability to say, you know what, we're not going to pay you, China. We're not going to pay you, whoever it is, right? And then they're in a financial difficulty. So these countries have been trying to diverse away from the U.S. dollar. It's why you hear about them not wanting to have the dollar as the reserve currency. And I think that may change marginally, but at the end of the day, most countries aren't going to trust the Chinese to have their money, right? They're going to be more trusting of us. So I never think the U.S. is going to lose reserve currency status, but it doesn't mean that the benefits that we got from that aren't decreasing. And we got to think about how these things are going to play out. And frankly, because like I said, we're in a situation we've never been in before, we don't actually know how it's going to play out, right? There is no roadmap for this.
So is that it, Larry?
No, I mean, we still got other things you got to worry about in the economy. Like I said, just because they cut interest rates, it doesn't solve some problems that people think it's going to solve, right? First off, there's a lot of zombie companies out there. By zombie companies, I mean that they were only able to stay in business because their debt was at low rates. And just because the interest rates are cut doesn't mean that now that people are realizing that they're not in great financial shape, that all of a sudden people are going to, loan them a bunch of money at lower interest rates. A lot of these companies are just going to have to go under, and there's going to be a big effect for that because a lot of debt isn't going to get paid, right? So you have a lot of problematic balance sheet in a lot of companies, and a lot of companies aren't able to grow, with higher interest rates. And we're hearing about layoffs every day. Part of that's because these companies can't service their debt, and they've got to be worried about it. Like, okay, if you've got, a $10 million bond that's coming due next year, and you're trying to see what to go raise money in the bond market, it may be that your bankers are saying, you know what? Yeah, but we can probably get you 5, but not 10. So they got to figure out, they got to have to pay off the other 5, or they're not even going to get that. So there's a lot of, balance sheet cash flow issues at a lot of companies. And I still think we're at the very beginning of the commercial real estate problems, right? You keep on hearing every day about these large buildings, in downtown LA, downtown Atlanta, downtown New York. And, they're being bought for 25 million and they were at 75 million, right? Before, right? So, there's still a lot of especially office buildings that are, that have to go under, and they're going to go under. And they've been, extending, banks have been extending, and they've been working on it, but a lot of these situations aren't solvable. So eventually they're going to they're going to go down. And that hasn't happened, and it's going to take a while to work through because a lot of people are holding on desperately, trying to make it work. And a lot of these banks are trying to work in the hope for a miracle or something like that. Or, I can push it out 2 years and I can retire before the problems really happen, right? That's a lot of that's going through, and there's going to be a lot of muddling through in with the regional banks, and a lot of muddling through in real estate, and it's not going to be fun. It's going to be really, really ugly.
You seem pretty dour. Any good news to finish up today?
Oh, absolutely. My Padres are in the playoffs.
Congratulations. Yes.
Thank you. You know, growing up in San Diego, being a San Diego sports fan is a really testament to, toughness and ability to stick with it, right? Because the franchises there have a history of just blowing it at, the biggest times, right? So now I'm hoping they can finally punch through and make a good playoff run. But, San Diego had the third highest attendance in Major League, set a record this year. I was actually there with my son when they set their single game attendance record back in May. So, my Padres are doing good. So that gives me some hope.
Well, in the spirit of baseball and the playoffs, another Home Run Financial Architects podcast. Thank you to Chief Investment Officer and Partner Larry Steinberg. I am Evan Makovsky, and we will see you on the next episode.